Okay, guys, we're going to look at 5 ETFs that our community has asked us to look at. First one is VTI. I pulled it up here on YCharts, which is an account I have. So VTI is a Vanguard total stock market ETF. Very low expense ratio, 0.03. That's why we love Vanguard. Vanguard keeps it cheap and puts more money in your pocket. Annual dividend yield about 1%. Now, this is not like the S&P 500. This is the total market index. Micro caps, small caps, mid caps, large caps, everything. And it tries to get a portfolio of stocks that matches that whole key characteristics of the whole thing. Now, it's only been around since 2001. Okay, so it's limited, 22 years, 22 and a half years. But let's look at some of the top holdings, and you think you'll probably recognize a few things here. Apple, Microsoft, Amazon, Nvidia, Google, Meta, Google, obviously Class A and Class B, Tesla, Berkshire. What does it look like? Basically looks like the stock market, right? Obviously, the largest companies are the top holdings because it's going to be market cap based. So one thing I want to compare it to, let's look at the actual performance of this compared to the S&P 500. Well, guys, this is the S&P total return. This is the Vanguard total stock market ETF. I don't think this includes dividend, but even at 1% per year for 23 years, it's probably still not beating the S&P. So right here, I just look at it going, I get it. It includes some micro, some small cap, should add some return, but it doesn't really seem to be doing that. So based on this, let's go to number 2, SCHG. This is a Schwab large cap growth ETF. Again, actually, I'm surprised by this. This is Schwab, 0.04% expense ratio, dividend yield, 0.44, which is okay. If you want a high growth company, you should be willing to sacrifice that dividend. It's better for a company that has a lot of growth potential to reinvest in themselves. Don't pay it out in a tax inefficient dividend. All right, about $22.5 billion there. Turnover ratio, very low, 9%. That's awesome. It means they hold their stocks for a very long time. So let's go to the holdings again. Let's see. Top growth, huh? Okay, I question that completely. But does this look familiar? Apple, Microsoft, Amazon, Nvidia, Google, Meta, Tesla, Google, Broadcom, United Health, Eli Lilly, Visa. Looks pretty similar, doesn't it? Okay. So let's go to performance. I have not looked at the performance yet. This one actually beats. And I don't think this includes the dividend in this one right here. So going back to 2010, it's actually beating. Wow, pretty impressive. Now, if you look here, it only beat starting in basically the big bull run after COVID. Because if you look back here, when it fell, it got back to even with the S&P. And then another big bull run here back in 2023. So one can make the argument that it takes major bull runs, maybe irrational bull runs, for this thing to really compete. Why? Magnificent Seven, right? These are the major holdings of this fund, and it goes along with it. My guess is, based on this, is a guess, it'll probably do worse in a bear market. Number 3, VGT, Vanguard Information Technology ETF. All right, so I'm going to compare this one to QQQ, because this one's trying to track technology. Okay, great, awesome. Let's look at their holdings. You ready? Apple, Microsoft, Nvidia, Broadcom, Adobe, Salesforce. A little bit different, but still a lot of your big players in here. Apple is 22%. Microsoft is 21%. The rest, less than 5%. That's pretty interesting. Maybe it's because of the big run up in them. They've had them for a long time. I don't know. Let's go to the fundamental chart. Let's do our max. How far back does this go? Back in January of 2004. It has crushed the S&P 500, but let's look at QQQ. QQQ has actually done better than this one. Actually done a little bit better. I don't know why, but we've seen in our videos. I always talk about SPY, VOO, and if you want some technology exposure, QQQ. So, I don't know. Seems like, and by the way, keep in mind, this started in early of 04, and June of 03 was basically the bottom of the tech crash. So to compare it at this time is pretty biased there. Now, speaking of QQQ, I'll pull it up right here. If you want to look at it, their expense ratio is about 0.2 with a dividend yield of 0.57. Fund number 4, QQQM. Higher dividend yield, I don't know how, and a lower expense ratio. Okay, so you get about 0.13 difference, but a lot of turnover here. Not a lot of assets under management. It's probably one of the smaller ones because it is a smaller thing. Let's see if there's any. Let's see the holdings. Basically the same thing. So it seems to be better than QQQ. Let's look up QQQ. Let's look max chart here. They're all in line. So might as well take that one because it's lower expenses and a higher dividend yield. Sure, QQQM if you'd like. Final one, VYM. Vanguard High Dividend Yield. Guys, remember, I don't want you dividend chasing. That's super important to me. Don't go chase a dividend. Make sure that when you find a company, the best use of their capital at that given time is paying a dividend. Because remember, it's double taxation. The company already paid taxes to get their bank account to where it was. And then when they give you the dividend, you got to pay taxes again. Okay? Don't believe that left garbage that it's lower tax rate. It is not. It is double taxation. Not to bring politics into it, but I knew Tim would laugh about that. Holdings. All right. a lot different here. JP Morgan, ExxonMobil, Broadcom, Johnson & Johnson, Procter & Gamble, Home Depot. Guys, these are all huge companies. I'm actually going to post this if you want some dividend. Let's go look at the expenses and what it taught. So look at this dividend yield, 4.12. Expenses, 0.06. Now, you want to compare this to something? Guys, at the end of this video, the next video will take you into our really popular SCHG video, so make sure you watch that video next. But let's compare it to SCHG. Again, it's a 4.12. SCHG, this has a higher yield than SCHG and about the same expense ratio. Okay, so not bad. So I like this a little bit more so far, a little bit higher dividend yield. Now let's go compare this to the S&P 500. Max chart, how far back does this go? November 2006. I was a wee lad back then. Oh boy. Guys, would you rather have 122% return over that time or 385%? At least with SCHG, the return, if you look at SCHG, let's go add SCHG to this thing. Yeah, I look at this going, guys, I'm sorry. I'd rather just keep it with S&P 500 total return. You want your goal, even if you're a dividend investor and you want the dividend income, your goal is still to get the higher total return. I don't understand the purpose of this. Guys, if you're truly interested in owning a dividend ETF, go check out our next video about SCHG.